Hi CA students, let's revise CA Final AFM Chapter 3 Advanced Capital Budgeting Decisions Illustration 6. So before proceeding with the video, please check the previous video for illustration 5 wherein I have explained the variance and the standard deviation. So it would be better to view that first and then come here. Okay, going to the question. Here the requirement of the question is about coefficient of variation of two projects. So variance previously, as I've explained, it is the variation from the mean, right? So in this question also they have given cash flows of two projects along with the probabilities. So first we have to calculate the variance, then standard deviation, then coefficient of variation is nothing but it's like a measure to find out which project is riskier, like which between two projects or two units, which is riskier one. So going directly into the question, for the two projects, as we can see, the standard deviation is coming up to 2190 for project A and 4195 for project B. So the coefficient of variation is nothing but standard deviation of a project divided by the expected cash flow of that particular project. In project A, we have got a expected net cash flow of 14,000 and in project B it is 18,000. So the standard deviation divided by the expected net cash flow, we are getting a coefficient of variation of 0.1565 in case of project A and 0.2331 in case of project B. So now both the projects become comparable. So how does this work? Let's say the standard deviation of project A is 2190 for 14,000 of expected cash flow. So what is for 1 rupee of expected cash flow? It would be 0.1565. Same way for project B, 4195 is for 18,000 rupees of expected cash flow. What is for 1 rupee? Then it would be 0.2331. So the standard deviation and the variance is more in case of project B. So in project A I am expecting 14,000 as expected cash flow, wherein I am certain about that 14,000 by 0.1565, wherein 18,000 in case of project B I am not that much certain because the coefficient of variation is more in case of project B. So the more the standard deviation, the more risk. The same case goes with coefficient of variation also. The more the coefficient of variation, then the risk is also more. So in project A, risk per rupee of cash flow is 0.16, while in project B it is 0.23. Therefore project A is better than project B as the risk is lesser. So we'll go with less riskier one, right? Thank you.